Friends, welcome to our today's session. And this is the seventh session on salary chapter. And we are discussing about perquisites. So various items of perquisites we had covered and few more are still there. We are going to address those issues now. Going to share the screen with you. In our previous session, we had already discussed about this particular perquisite, which is a car facility. We know, depending upon the situation, there might be some situation where car is ownership of the car is with employer might be the owner, employee might be the owner. Car may be maintained by the employee, may be maintained by the employer. Car may also be used for official purposes or for personal purposes or for both. In different situations, the value of the perquisite will be different. And we have made a list of 10 combinations. On that basis, we'll be able to arrive at the value of car facility as a perquisite. Then after that, if driver is provided or chauffeur facility is also provided, then additional amount is to be added with the value of car facility. That also we had discussed in our previous class. Vehicles other than car, if that facility is also provided, then how that will be valued as a perquisite. That also we had discussed in our previous class. Free meal, it has been discussed. Travel, tour, holiday home facilities, those has been discussed. Credit card facility has been discussed. And yeah, this was also discussed. Gift or gift vouchers given by the employer, right? So cash gifts are fully taxable. Cash in kind are exempted up to rupees 5,000 rupees in aggregate during the financial year. Beyond that, beyond 5,000 rupees, it is taxable. We have to start from here. Today's discussion will from this perquisite. This is about club expenditure. Okay, so some employers provide club facilities to their employees. If it is a health club facility, then it is not taxable. Okay. If it is a sports club or similar club facility, then also it is not taxable. Employer is providing employees this kind of facilities. But if it is other club, which is used for official purposes, right? Other club facility that is not a health club, not a sports club, not a similar club like sports club, yoga club like this. It is not like that. But if there is some other club facility which is used for official purposes. Official purposes are normally exempt, but here also it will be exempted. But some evidences are required. What is required is that detail of expenditure needs to be maintained by the employer. Employer needs to maintain how much expenditure has been incurred. Then employer also needs to certify that the expenditure is wholly and exclusively for performance of official duties. If these two conditions are complied with, then only club facilities or any other club facilities shall be exempted to an employee. Okay, understood up to this?
Yes, sir.
Okay.
Yes, sir.
Now, sometimes what happens? Club membership is a kind of corporate membership. Sometimes some employer take corporate membership. That means company is the member of the club and employee can enjoy that facility. If that situation, suppose it is a corporate membership obtained by the employer and the facility is enjoyed by the employee or his household member. In that case, what will happen? Corporate membership means initial fee must have been paid by the company, must have been paid by the employer. In this case, what will happen? Initial fee paid for corporate membership is not taxable. Employer is a member, employer has paid the initial fee, that is not taxable. Other expenditure shall be taxable in the hands of the employee. Membership is corporate, it's a corporate membership, but facilities are enjoyed by the employee. Therefore, for employee that is a perquisite and other expenditures shall be taxable in the hands of all employees. Okay. Okay.
Yes, sir.
Yes, sir.
Now, third, one more situation is club facility in any other manner. Any other manner means what can be the possibilities? Maybe employee is a member somewhere, employer is reimbursing the club facility. That possibilities one may think of. In that case, expenditure incurred by the employer shall be a taxable perk for all employees. All employees means whether he is a specified employee or unspecified employee, doesn't matter. It is taxable perk. So club facility, any other manner shall be fully taxable for all employees to the extent expenditure is incurred by the employer. Did you understand this about club expenditure? Well,
Yes, sir.
okay. Now, friends, this is one more kind of perquisite. You can read the title. What kind of perquisite you are talking about now? We are going to talk.
Sweat equity.
Have you heard of this? ESOP, ESOP,
Yes.
ESOP or sweat
Yes,
equity.
sir.
Yes,
Yes,
sir.
Heard of this? Can you tell me what is this sweat equity and ESOP? Can anyone tell me?
Sweat equity are
The
generally
savings
issued to the
offered to the
promoters or
employees.
directors of the company.
Yeah, these are in fact securities, meaning shares issued to employees. So, yeah, sweat equities are normally issued to the directors or employees at a discount. Discount means you can say the fair value of the shares might be 600, but it is issued to the employee for 200. So value of discount is 400. Okay, 400 rupees discount is given. So sweat equity shares are issued maybe to directors to employees at a discount for a consideration other than cash, for providing know-how or making available rights in the nature of intellectual property right. So this is something sweat equity shares are allotted. But what is ESOP? ESOP is a right given to the employee. They may exercise that right. They have option to use that thing. Okay, at a predetermined price, at a discounted price, employees are issued to these shares. Employee are given that rights. If the employee want, he can exercise the option and can avail that right. ESOP stands for Employee Stock Option Scheme. In both the cases, what happens? Employee gets a share at a concessional price. Okay, right?
Yes,
Now,
yes,
what will be the taxable perquisite? It is taxable perquisite in the hands of all employees, right? And how will arrive at the value? Fair market value of the shares and securities after subtracting the amount charged from employees. Suppose fair market, the example I gave you, suppose fair market value is 600 and the employer is charging 200, right? So fair market value minus amount charged. The difference shall be the value of the perquisite. And it's taxable
Okay,
in the hands of all employees. Okay, right?
yes, sir.
Now, when it is taxable, it will be taxable in the previous year in which such securities are allotted or transferred to the employees. Okay, so just because let us say employer has given an option, but employee has not availed, it will not be taxable. When employee avails it and shares are issued, then only it will be taxable in that year. Okay,
Yes, sir.
right. Now, there is a special treatment for ESOPs or sweat equities issued by eligible startups. You might be knowing who are the startups. These are the startup companies who are registered with various authorities, new companies that form. As you know, government is taking a lot of measures to help them. So in case these companies enjoy a specific benefit, in case they issue ESOPs or sweat equity shares, then their taxability is deferred. Right. So tax on perquisites of specified securities and sweat equity shares required to be paid in the year of exercising the option. Normally, what happens when sweat equity shares are issued or ESOPs are issued, it is taxable when option is exercised. Is it not? Just now we learned this thing. When employee will exercise the option, then it will be taxable, right? But if these type of securities are issued by eligible startup companies, then they are taxable in which year? You see, 3 points are there, point 1, 2, 3, whichever is earlier. At that point of time, it will be taxed. Okay,
Yes,
right?
sir.
And what are these 3 points? After expiry of 48 months from the end of the relevant assessment year. That means for 48 months means how many years?
4 years.
4 years from the end of the assessment year. It is deferred. Or in which the sale of security, sale of such security, let us say employee disposes of that security, employee sells that security, then that date. Okay. Or in which the assessee ceases to be the employee. Let us say assessee leaves the job. Right. So that date. So these 3 things will take. These 3 years in which your 48 months expires, in which year, let us say, securities are transferred or sold, or in which year the employee ceases to be the employee. Whichever is earlier, in that year only it will be taxable. Okay, so now you have understood that this tax liability is deferred for eligible startup companies. Okay,
Yes, sir.
right. Now you might be thinking, as I told you, you need to arrive at the fair market value. And from that, you need to deduct the amount which is charged by the employer. Now, question arises how to arrive at the fair market value. Okay, now you see this table will help you. If the securities are listed, if they're listed securities, listed means listed in one of the recognized stock exchanges. What we'll do, we'll find out when that option was exercised. We'll find out the average of opening price and closing price. In the stock exchange, throughout the day, price changes, is it not? We'll find out on the date what is the opening price, what is the closing price. We'll average it out, and that price shall be treated as a fair market price. Okay.
Yes, sir.
Yes, sir.
And in case there is no trading on that day, let us say option is exercised on a date, and that date, that particular share is not traded, then what we'll do, we'll take the closing price of the closest date, nearby date, we'll take it. Okay.
Okay.
Okay. Now one more thing. So this is possible in case it is the securities are listed in one stock exchange. But let us say securities are listed in multiple stock exchanges, with more than one recognized stock exchanges. Then the price might be different. Is it not? So you
Yes,
might
sir.
be knowing. So in different stock exchanges, prices are normally different. In that case, what we'll do, we'll take the average of opening and closing price. But which stock exchange? We'll pick up that stock exchange's price which records highest volume of trading. We'll find out in which stock exchange this particular shares trading volume is higher. Okay, that stock exchange's opening and closing price has to be taken. Okay.
Yes, sir.
Now, this is about listed securities. Listed securities, okay, stock exchange is there, prices are there. But in case securities are not listed, it may be a, let us say, private limited company, or it might be public limited company, but which is not listed. Then naturally, the market, it will be difficult to find out the market price. Is it not? In that case, what will happen? Fair value determined by category 1 merchant banker on the date of exercise of the option, or any earlier date, not earlier than more than 180 days. That means 6 months, not more than 6 months earlier. That value has to be taken. That means you need to do a valuation from a category 1 merchant banker. He will tell you what is the value, and that is the fair market value of the security. Okay.
Yes, sir.
Yes, sir.
Right. Okay, so that perquisite is over. Now we'll be learning a new perquisite now. As you can see, now this is what perquisite? Can you tell me?
Leave travel concession.
Leave travel concession, or LTC. Right. So as you can see, we are categorizing in them in two parts. One is LTC. It is also referred to as LTA, that is leave travel assistance. Okay. In India, outside India. That means these facilities are provided in India or outside India. Right. If it is provided outside India, then what is the treatment?
It will be fully taxable.
Fully taxable. Let us say the employer has provided the facility that employee can go beyond India. Employee can go to Switzerland and enjoy LTC. Then it is fully taxable. Whatever facility is provided, that is fully taxable. But if it is within India, then we have two parts. One is stay cost and other cost. That is employee stay cost, fooding cost, etc. And second part is the traveling cost. Okay. Stay and other cost is fully taxable, even if it is in India. Okay.
Okay, sir.
But travel cost, if it is reimbursed by the employer, it is exempted on actual basis. Actual basis. But however, in case of air route, maximum economic class fare of national carrier by shortest route has to be exempted. So we have to compare the what is the economic class fare, not business class, not executive class fare. Business class fare by the national carrier. National carrier means Air India. So for the same distance, we have to compare what is the air charges of Air India in economic class and by the shortest route. Okay, by the shortest route. Okay, suppose from Bhubaneswar you want to go to Kashmir. It doesn't mean that you will go to Bombay, Bombay to Chennai, Chennai to go to Kashmir. So that is not the shortest route. You will find out what is the shortest route and what is the fare by Indian national carrier, that too economic class fare, and that fare is the maximum limit. Okay, maximum, that is the limit. Travel cost is exempted up to this. Did you understand up to this?
Sir, exempted.
Yeah, exempted
Sir, exempted on actual basis means?
means actually you must have incurred that expenditure. You must have exempted, right? Suppose you have incurred less than that, then lesser amount will be exempted.
Okay, sir.
Okay.
Yes, sir.
Exempted on actual basis means actually you must have incurred that expenditure. You must produce your, let us say, ticket or boarding pass, which will show an evidence that actually you have incurred. It is exempted on actual basis. That is the
Yes, sir.
basic condition I told you. But now you see some additional things I'm telling you related to that. It's not necessary that employee is always going to travel by air. In other case, how treatment will be made. Where is journey is performed by air, as I told you, amount of economic class fare of the national carrier by the shortest route, or the amount spent, whichever is less. This amount will be exempted. Okay.
Yes, sir.
And in case, this is the maximum amount which can be exempted. In case employee has traveled by rail, then on actual basis, right? Again, here actual basis is important. Employee has not traveled by air. Then what we'll do? Amount of air conditioned first class rail fare by the shortest route. That means first class AC fare by the shortest route, or the amount spent, whichever is less. If the employee has traveled by rail, maximum is the first class AC fare by the shortest route. Okay.
Yes, sir.
And third situation is that when the place of origin of the journey and the place of destination of the journey are connected by rail, but journey is performed by some other mode. Let us say rail is connected, but employee is traveling by his own car, or he is going by bus, or any other way. Then he may do anything, but amount is limited to the amount of first class AC fare, air conditioned first class rail fare by the shortest route, or the amount spent, whichever is less. Here we have to compare your expenditure with the first class AC fare, and we'll see how much amount you have spent. Whichever is less, that is the amount of exemption. Okay.
Yes, sir.
Now, where the place of origin of the journey and the destination are not connected by rail, not connected by rail, then what we'll do? Where a recognized public transport exists, then we'll compare the first class or deluxe class fare of the shortest route. Suppose there is a bus route is there. So first class, deluxe class fare of the shortest route or the amount spent, whichever is higher. Okay. And where there is no recognized public transport, then we have to find out air conditioned first class rail fare by the shortest route or the amount spent, whichever is less. Okay, what we'll do for the same distance, what will be the AC first class rail fare we need to arrive at, and we have to compare it with the amount spent. Whichever is less, that amount will be exempt. Did you understand this?
Yes, sir.
Okay, so no public recognized transport exists. So air conditioned first class AC fare means for the same distance you need to compute what will be the first class AC fare by rail, and that is the upper limit, right?
Yes, sir.
Okay. Now, few more things also we need to learn as regards to LTC. Concession received by employee, it may be for himself or for family, for traveling any place in India is exempted, right? Exempted, I told you, to some extent it is exempted. To the extent of the amount of the following. What is that following amount? This exemption can be availed 2 journeys in a block of 4 years. So what happens? We have some fixed blocks for us, for assessment year 21-22 if you are talking, or previous assessment year, let us say you talk it 2021 also. What is the block? Block is 2018-2021, 2018 to 2021. So these are 4 years or not? 18, 19, 20, 21. And here we are talking about calendar years. Okay.
Okay.
Calendar years, not financial year. So in this block, okay, 18 to 21, maximum 2 journeys are exempt. Not more than that. In a block of 4 years, maximum 2 journeys are exempt. Did you understand?
Yes.
Okay, traveling is exempt, but maximum for how many journeys? 2 journeys in a block of 4 years. For next assessment year, next block will start. 21, 20, right? 21 is over, 22, 23, 24, 25. So 22 to 25 is the next block. So the blocks are fixed for 4 years, right? But however, one more thing. Out of these 2 exempted journey, 2 journeys are exempted in a block of 4 years. One can be carried forward to the first year of next block. Let us say one employee was supposed to avail 2 journeys, right? But he could avail only one. Another journey he could not travel. In that case, what will happen? Maximum he can carry it to the next block, but that has to be adjusted in the first year of next block, right? That means the next block, first year is 2022, right? In this year, the first journey needs to be that carry forward journey needs to be adjusted. So next block he can avail 3 journeys.
Okay.
Existence for 3 journeys, but the journey which is carried forward that must be adjusted in the first year itself. That means in the calendar year 2022, right?
Yes, sir.
So therefore, if you read the last point, out of these 2 exempted journeys, one can be carried forward to the first year of the next block. This will be an additional exemption for the next block, that is 22 to 25. So in the block 22-25, he can take maximum 3 exemptions. But one exemption should be existed in 22 itself. Right?
Yes, sir.
So this concept you have to remember. This is a block in, this is how it will be allowed. And in that context, you have to also remember that if there is a fixed LTC, not an actual basis, that means fixed. Employer pays fixed amount, let us say take 50,000 rupees fixed. Then it is fully taxable. That means it is not an actual basis. It is an allowance kind of thing, fixed allowance. Then it is fully taxable. And here you see these facilities can be employed by the employees, used by the employee or the employee's family. Here family includes spouse, children, parents, brothers, sisters who are wholly or mainly dependent upon him. Okay, family means these are the family. And so far as children are concerned, exemption is for 2 children. And in case of multiple birth, then all those children shall be regarded as one child. And exemption is available maximum for 2 children. But if the children are born before 1st October 1998, then all children are eligible for this exemption. Okay.
Yes, sir.
Right. So family includes spouse, children. Children is maximum 2 children, but if the children are born before October 1, 1998, then all children are included. Parents, brothers, sisters are included when they're wholly or mainly dependent on the employee. Okay. And fixed travel LTC, fixed leave travel allowances are fully taxable. Okay. Understood this concept?
Yes, sir.
Okay, friends. Now, one more point you have to remember. New provision, and this has come in the last budget only, recent budget. This is leave travel concession voucher, leave travel concession cash voucher scheme. Okay, our finance minister has introduced this new scheme, and this is notified by the government in budget 2021. So the objective of this scheme is to boost consumer demand of some products, and also to provide this LTC tax benefit to individuals who are unable to claim usual LTC tax benefit due to COVID related travel restrictions. As you know, in a block, you can avail maximum 2 journeys in a block of 4 years. Is it not? But
Yes, sir.
last year, what has happened? You know, last year there are a lot of travel restrictions. So many employees have not traveled, in fact. Okay, due to this COVID-19 restrictions, employees could not travel. So government has extended that facility that you can still avail that facility, provided you spend some money in some specific items. And this particular cash voucher scheme is available to both government employees as well as non-government employees. Okay, LTC benefit can be availed provided these conditions are met. And these are the conditions which government has provided. The employee must have spent 3 times of the amount of deemed LTC spare. Okay, suppose he's eligible to get 20,000 rupees LTC benefit, LTC fare benefit. So 20,000 into 3. So 60,000 he must have spent. On which item? On purchase of goods or services attracting GST of 12% or more. Okay, he must have spent that money for acquiring some asset and something he must have purchased, and where he must have paid GST at the rate of 12% or more. And this purchase, when he should have purchased? Between October 12, 2020 to March 31st, 2021. During this period, he must have purchased. October 12, 2020 to 31st March 2021. Okay, right now also time is there. So one can purchase.
Sir, why it is October 12th?
On that day, notification has come. When the notification has come, at that time only government declared this. Okay, initially notification came for government employees, then it is extended for private employees in 2 different dates. So we are not in fact going deep into the scheme, only at surface level I am telling you. If you are interested, you can Google it and find out what is this scheme. At very basic level, in fact, the scheme contains a lot of FAQs, frequently asked questions, which are there to clarify various issues related to this scheme. But broadly, we need to understand that employee can get benefit of this deemed LTC but he must, what is required is that he need to spend 3 times of the deemed LTC amount, LTC fair amount on certain goods and services by paying GST of 2% or more. And he must have spent this money between October 12, 2020 and March 31st, 2021. The payment must be made through digital mode, including checks, etc. Then invoices must be furnished to an employer containing details of the vendors, GST numbers. Okay, all these things are required. Okay, so GST invoices are required. And it is also possible that invoices may be in the name of family members. That will also do. And there is a restriction for private sector employees. They can claim maximum 36,000 per month. So these are certain restrictions are there if somebody wants to avail this LTC cash voucher scheme. Okay. So this, since this is a new thing which has come in the budget, so we need to have little idea on this. Okay.
Yes, sir.
So this is regarding LTC. Now, friends, one more important provision we need to cover. This is about employees' provident. So some of you might be familiar what is a provident fund, some of you may not be. So if you talk about employees' provident fund, the normal scheme is like this. Employee contributes 12% of the salary. Normally what happens, contribution comes from employee side and employer also adds some contribution, is it not? So PF contributions come from both the sides. This is from employee, this is from employer. How much employees normally contributes? Normally, how much?
12%.
12% of the salary. How much employer contributes? You see, employer's contribution has this breakup. Employers, 3.67% towards EPF. Okay, that is employee provident fund. 8.33% towards employees pension scheme. So these two taken together, how much? 3.67, 8.33. How much?
12%.
12%.
So you see, 12% is coming from employee, and under these two schemes, 12% is also coming from employer, right? But in addition to that, employer also pays 0.5% towards employees' deposit-linked insurance and 1.1% as EPF administration charges and 0.01% as EDLI administration charges. For these two schemes, two administration charges are there. Okay, so this is the total amount employer pays and this is what employee pays. And entire money is deposited with PF authorities. Okay, to
So
whom?
3.67 sir, this 3.67 or 8.33% calculated on employee salary.
Yeah, on salary. Okay.
I mean,
Now,
8.50% is employee salary.
all these are calculated on employee salary.
Sir, when you say salary, is it basic salary or the total salary?
Basic plus some elements of salary.
Okay.
Okay. Now, where this scheme is applicable? So establishment where employee strength is 20 or more than 20%. 20 or more employees are there, then this PF is applicable to them, EPF. But establishment with less than 20 employees can also voluntarily join this scheme. Voluntarily, they may want, if they want, they may get themselves registered with EPF authorities. In that case, they can contribute, instead of 12%, employees can contribute 10%. Okay, under voluntary scheme. Okay, that is also possible. Now, what you have seen here, you see contribution, employees contribution, you see 12%. Employers contribution, if you take all these things taken together, it comes to 13.61%. So total 25%, 25.61% is deposited. And as you, since you asked about the salary, you see this is the statutory amount which needs to be deposited. And for this, the salary you can say the eligible salary is 15,000. That means if the employee salary is more than 15,000, then he need not cover under EPF. And the prescribed wage selling is 15,000. So sometimes some organization, what they do on this basic 15,000, they deposit the money, deposit EPF money. And this money needs to be deposited before 15th of every month. And as I told you earlier, the scheme is applicable, or the law is applicable to those factories and those establishments where employee strength is 20 or more. And if the employee strength is less than 20, voluntarily they may adopt. They may voluntarily get themselves registered under EPF. Okay, got a fair idea?
Yes, sir.
Now, when employee withdraws the money, PF withdrawal, on his retirement at the age of, on his retirement or on attending the age of 55. Okay, employee can withdraw. Employee can withdraw his PF amounts on his retirement or at the age of attending 55. He can withdraw the whole amount of EPF along with employer's contribution, employee's contribution, both can be withdrawn. And even before attending the age of 55 or before retirement, also employee can withdraw the whole amount if he switches or changes his employment. Or you can say it in different way. In case employee doesn't attend the age of 55 or is below the age of 55 or retirement age, but switches or changes his employment, he can also fully withdraw his EPF balance in case he's not in employment for 60 days or more. If the employee, that means if the employee remains unemployed for 60 days or more, then also he can withdraw the full amount, employee's contribution as well as employee's contribution. These are the withdrawal possibilities. Now, what is important for us is how we'll treat it from tax point of view. Okay, from tax point of view, friends, we have classified this PF into 4 categories. As you can read here, what is this? Can you read it here?
Statutory
Statutory Provident Fund. Then can you read it here?
Recognized Provident Fund.
Recognized Provident Fund. This column.
Unrecognized
Unrecognized Provident Fund.
Fund.
And this one.
Public Provident Fund.
Public Provident Fund. So we'll classify this Provident Fund into 4 categories. Statutory Provident Fund. Okay. Where treatment I have written EEE means exempt. In all the cases it will exempt. We'll be understanding what does it mean. Recognized Provident Fund, you see EEE but with an asterisk back. That means EEE but subject to certain conditions. Then unrecognized Provident Fund, EET means exempt at tax. Lastly, when you withdraw the money, it will be taxed. And Public Provident Fund, again EEE means what?
exempt and
Exempt. Okay, we'll be understanding. But before that, let me explain you what is this statutory provident fund, what is recognized provident fund, what is unrecognized provident fund. A recognized provident fund means a provident fund which is recognized by Commissioner of Income Tax. For the purpose of income tax, it has been recognized. Okay, if the fund is recognized by Commissioner of Income Tax, we'll call it as recognized provident fund. Unrecognized provident fund means which is not recognized by the Commissioner of Income Tax, but company is having that fund, or employer is having a fund which is not recognized by Commissioner of Income Tax. Statutory Provident Fund can be referred to as Government Provident Fund. It is established or it is governed by Provident Funds Act 1925. So government, railways, semi-government institutions have used this kind of fund. Public Provident Fund, it's governed under Public Provident Fund Act 1968. These funds are available. You can also participate in this fund. In post office or banks, you can deposit money under this PPF scheme. It is open to any individual, whether it's an employee or not. If it's self-employed persons can go and open an PPF account. You can also do it. Right. So in banks as well as post offices, these schemes are available. That is called PPF. Did you understand what is statutory? what is public, what is unrecognized, and what is recognized. So on that basis, we have classified 4 kinds of provident funds. Okay. Right.
Yes, sir.
Now let us see what are these are the cash flows associated with the provident fund. First of all, employer's contribution to provident fund. Okay, employer's contribution, the money which is employer is paying, it is not taxable if it is statutory provident fund. Employee's contribution is not taxable at all because it is not an income. Employee is paying that money, it is not an income. So employee's contribution, nowhere it is taxable, always it is not taxable. Okay, but employer's contribution is an income, but it is not taxable here if it is statutory provident. And deduction of employee's contribution, you know, there are under section 80C, employee or assessee avail certain deductions. Is it done? Like investments made in life insurance policies, or purchase of national savings certificate, or money deposited under provident fund schemes. So this deduction is available under section 80C for statutory provident funds. Okay, so deductions are available. The interest which is credited, that is also exempt. Fund interest will be credited, that is also exempt. Lump sum withdrawal is also exempt. Okay, now you see employer's contribution is exempt, interest is exempt, withdrawal is exempt. Therefore, it is called EE or exempt. Okay. Did you understand statutory provident fund? Okay. Now,
Yes, sir.
recognized provident fund. Recognized provident fund, as you know, which is recognized by Commission of Income Tax. Employer's contribution, you see, exempt, that is not taxable, up to 12% of the salary. If employers contributes more, then additional amount will be taxable. And here, what is the meaning of salary? Salary here means basic plus DA if it forms a part of retirement benefit, plus commission if it is fixed as a percentage of turnover. That is how salary has been defined. So employer's contribution is exempt, maximum up to 12% of salary. Employee's contribution, of course, it is not taxable because that is not an income. And 80C deductions are also available. Interest is exempt, but up to 9.5%. If more interest is credited by the fund, then the extra amount will be taxable. But interest credited up to 9.5% is exempt. And lump sum withdrawal is not taxable on retirement or termination after 5 years of continuous service. Only when employee, let us say, withdraws the lump sum amount after 5 years, then it is not exempt. So as you can say, it is exempt, but subject to certain conditions. Employer's contribution up to 12%, interest up to 9.5%, and lump sum withdrawal only after 5 years. Retirement or only after 5 years. Okay.
Yes,
Got
sir.
it. Got it.
Yes,
Now, friends. Now, next is unrecognized provident fund. As you see, this is EET, meaning
exempt and taxable.
employer's contribution not taxable. Employee's contribution is of course not taxable as it is not an income. Deductions on employee's contribution. Deductions is not available. Employee cannot take any deduction from unrecognized provident fund. Interest credited is exempt. Interest is exempt, is not taxable. And lump sum withdrawal. Lump sum withdrawal is taxable. Therefore, lastly, it is taxable. When employee withdraws money, how it will be taxable? Employer's contribution part. Okay, when lump sum final maturity amount will be withdrawn, the employer's contribution part will be taxable as salary. But employer was contributing, it was not taxable. But when we withdraw that money, it is taxable as salary. Interest on employer's contribution, that is also salary. Employee's contribution is not taxable because that is not an income. But interest on employee's contribution, employees have contributed, have earned some interest. That's taxable under the head income from other sources because that is an interest income, not a salary income. Okay, so therefore, unrecognized provident fund, it is exempt and tax.
Sir, what is the difference between unrecognized, recognized, and means what are all these provident funds? Why 4 heads?
What are these
Not
provident
everything is
funds?
recognized.
Just now I explained,
Everything is recognized.
just you see, before few minutes I explained you what are these things. Who can tell me what is statutory provident fund? Can anyone tell me what is recognized provident fund, unrecognized provident fund?
Recognized provident fund are funds which are recognized by the income tax officer.
Commissioner of Income Tax.
Commissioner of Income Tax. Unrecognized provident fund?
Not recognized by the
They are not
Commissioner.
recognized.
What is public provident fund? Okay, once again I explain you. Okay, recognized provident fund means recognized by Commissioner of Income Tax. Unrecognized provident fund means which is not recognized by Commissioner of Income Tax. Statutory provident fund is governed by a specific act, Provident Funds Act 1925, and it applies to government employees, railways, semi-government institutions. Public provident funds are open public fund. It's open for general public, and these accounts, public provident fund or PPF accounts, are available at post office and banks. You can go, whether you are salaried employee or non-salaried, even you can also open an account under PPF scheme. So these are the 4 categories of provident funds. Is it clear to you? Treatment,
Yes, sir.
treatment wise, all are different. That's what we are learning here. Treatment wise, it is different. Okay.
Yes.
Up to this, you have understood what is the treatment for statutory provident fund, recognized provident fund, and unrecognized provident fund. Now let us see this part, public provident. Public provident fund, as you know, it is open to public. That means even non-salaried people can open this account. Here, employer doesn't contribute. You have opened an account, employer is not contributing. So taxability of employees' contribution doesn't arise. Employees' contribution not taxable. Okay, employee or the person who is putting money, it is not an income, it's not taxable. Deduction under ATC, yes, it is available. Interest credited is exempt. And lump sum withdrawals are exempt. So you can say contributions are exempt, interests are exempt, withdrawals are exempt. Therefore, we are calling it as EEE scheme. Okay. Did you understand?
Sir, in case of public provident fund, sir,
Yeah, tell me.
sir, in case of public provident fund, can a person with salary higher than 15,000 register himself or herself?
Yeah, anybody can open it. Okay, public provident fund is an open scheme, right? Even if you don't have any salary or you have any amount of salary, you can open it.
Okay, sir.
Okay, you can try, go to a post office nearby and ask there to open a PPF. You can definitely, you'll be able to open that account, PPF account, or go to State Bank of India and ask to open a PPF account. They'll be helping you. Okay.
Yes, sir.
Right. I told you one more condition. Here there is one condition that lump sum withdrawals are not taxable on retirement or termination after 5 years of continuous service. Let me elaborate that thing. Here, how to test or in which situation, how to, or in the context of that 5 years continuous service, we have to check one few more things. You have to check, has the employee rendered continuous service of at least 5 years with the employer? If yes, then it is exempt. But if it is no, let us say 5 years continuation service is not there, then again we have to analyze what is the reason. Whether he has left before 5 years because of ill health or because of discontinuance of employer's business, or it is due to some cause which is beyond the control of employee. If these are the reasons, then even if employee has left continuation service before 5 years, then also it is exempt. If this is not the reason, some other reasons are there, then it is taxable. Okay. Okay.
Yes, sir. Yes, sir.
So if employee has left for ill health or for discontinuance of employer's business or for some causes which are beyond the control of employee, then even if employee has not rendered 5 years of continuation service, still it will be exempted. Okay.
Yes, sir.
Well, now few more things related to salary. Let us quickly learn. One is National Pension Scheme. This is also one more scheme where money can be deposited. Government and other employees can contribute 10% of salary to National Pension Scheme. Employer can make matching contribution. Employee can, in addition to that matching contribution, employee can make additional 50,000 contribution. Employer's contribution shall be first included in the salary. Let us say employer is contributing to National Pension Scheme, that is first included in the salary. Then subsequently deduction will be allowed. We'll be seeing that. Then up to 10% of the salary shall be allowed as a deduction. Employer can contribute 10%, and up to 10% of the salary is allowed as deduction under section 80 CCD2. Employee's contribution up to 10% is allowed as a deduction. In addition to that, if employee is making contribution, then additional amount up to 50,000 shall also be allowed as deduction under section 80 CCD1B. Okay, so this additional 50,000 also allowed as a deduction. But aggregate of deductions, here the provision is aggregate deductions should not exceed 1,50,000. But for which section? 80C. 80C means various life insurance premium, etc. you have paid. So this thing, children's education fee, etc. you have paid. 80C and 80CCC is for pension scheme. And 80CCD1. 80CCD1 means this part, employees' contribution towards National Pension Scheme. All this taken together, all these three, the overall limit is 1,50,000. This much deduction will be given. Okay, but you see, employee is also making, in case employee making additional contribution of 50,000. 50,000 rupees is allowed under which section? 80 CCD1B. 80 CCD1B is not covered in this overall ceiling. So for under 80 CCD1B, employee can take additional deduction of 50,000. Right. So 1,50,000 deduction is allowed under section 80C, 80CCC, 80CCD1. In addition to that, if employee has contributed to National Pension Scheme under section 80 CCD1B, then he can get additional deduction of 50,000. That means his total deduction can become 2 lakh, 1,50,000 plus 50,000. And this is a pension scheme, and pension received from this fund is taxable. And here, when I say 10% of the salary, salary means basic salary plus DA, it forms a part of retirement benefit plus commission if it is fixed as a percentage of turnover. Did you understand National Pension Scheme?
Sir, what did you tell about that 80 CCD1B that he can claim additional 50,000? That
Yes.
is, so I could not understand that thing.
You
It
see,
is not included, it is written.
not included means, you see, here it is not included under this overall limit. Overall limit is how much?
1,50,000.
1,50,000 for which section? You see,
80C, 80CCC and 80CCD1.
here that 80 CCD1B is not included. When I say aggregate of the deduction cannot exceed 1,50,000, in this line, this is not included. That means this is the additional deduction which is allowed, which is available. Okay. 80 CCD1B is not included with the overall restriction, overall limitation of 1,50,000. So 80 CCD 1B, you can contribute up to 50,000. That you
Okay,
can
sir.
have an
Got it.
additional deduction. So your total deduction can be 2 lakh rupees.
Sir, in that case, an employee whose 10% of salary is more than 1 lakh. 10% is more than 1 lakh.
Okay.
So that employee's contribution up to 10% here, say 1,20,000 plus this 50,000 he's making.
Yes.
So in that case, what will happen?
Yeah, whatever he has contributed under 80C, 80CCC, 80CCD. So your example, all these taken together, let us say 1,20,000. Plus addition, if he has made 80CCD contribution under 50,000. So another 50,000. So 1,20,000 plus 1 lakh plus 50,000. So 1,70,000 can be the total deduction. If you have understood your question correctly. So his entire contribution is, here is, you said 1,20,000. In addition, he has contributed 50,000. So 1,70,000 he can claim.
So then I will like to revise my question. If suppose that 10% is more than 1,50,000, say 1,70,000.
Then it is limited to 1,50,000. Then that is limited to one, that is aggregate limit, that is 1,50,000. Plus, if he has made additional contribution here, let us say he has made under 80 CCD, not 50,000, he has made again only 20,000. Then 1,50,000 plus 20,000, the 1,70,000. In case he has made under 80 CCD 1B another 50,000, then 1,50,000 plus 50,000, 2 lakh rupees.
Okay. Thank you.
Okay.
Yes, sir.
Okay. And this NPS account has got a two-tier system, two-tier benefit. So tier 1, just for basic information, we need not go deep into this. Tier 1 is the mandatory amount which to be contributed. It cannot be withdrawn before the maturity of the scheme. Tier 2 is voluntary contribution, can be withdrawn. Okay, but tier 2 contribution doesn't enjoy any tax benefit. This is the extra thing, just keep in the mind. In case you go for NPS scheme, so understand under which tier you are contributing, what are the benefits. You can ask those people, they will be explaining. Okay, so NPS, that much is relevant for us. Okay, one more fund we need to learn is about approved superannuation fund. So deduction under section 80C is available against employees' contribution to approved superannuation fund. If employee is making some contribution for an approved superannuation fund, deduction is allowed under section 80C. Interest received from this approved superannuation fund is exempt from tax. Employer's contribution to the approved superannuation fund is exempt, but same up to 1,50,000 rupees per year. Excess amount shall be taxable. And the amount received from approved superannuation fund is exempt. Okay, final amount when you are receiving for approved superannuation fund, that is also exempt. So this is the treatment for approved superannuation fund. Okay.
Yes, sir.
And when I say approved fund means approved by the Commissioner of Income Tax. Well, so this is, with this we covered perquisites and some important other provisions, also related provisions we also cover. Now, one more very important thing is about deductions under income tax law. I am giving you some brief idea. Next class will be trying to address this issue. As you already know, or in initial classes, I had already explained you that income tax is payable on total income, right? But total income, how it is arrived at? For that thing, first of all, we'll arrive at the gross total income minus some deductions, we'll be getting total income. Gross total income means income from all these 5 heads, as you can see here. Can you read it? What are these heads?
Salaries,
Income from house property, profit and gains, business or profession, capital gains, income from other sources.
Yeah, you see these are the different sections which are related to that. So these 5 heads income will arrive at. Then what we'll do, we'll aggregate them. Then if clubbing provisions is to be applied, then we apply that provision. clubbing provisions means in some other person's income needs to be clubbed. Let us say spouse income, minor child income in certain situation that needs to be clubbed. That has to be applied. Plus carried forwarded losses, if any, that needs to be set off. If earlier there were some losses for which return has been filed and it has been carried forward, that needs to be set off. So after making these two adjustments, that means adjustment for clubbing provisions and adjustment for carry forward losses, we'll be getting an amount which will be referred to us, that will be called as what?
Gross total income.
Gross total income. But tax is payable on total income. From that, we have to deduct chapter 6A deduction. Gross total income minus chapter 6A deduction. These are covered under section 80C to 80U. We will be getting total income. The total income will be rounded off to nearest rupees 10 and tax is payable on that. Tax is payable on total income. Okay, so here you see a deduction is allowed here, that is called as chapter 6A deduction. But apart from this, here chapter 80C to 80U, all these deductions are allowed here. Okay, but apart from this, each chapter also, or under each head, there are certain deductions. For example, if we are coming to this salary head, income under the head salaries, you have seen salary has got all these components. Basic salary, you know, allowances we have seen, perquisites we have also seen, and also it has one more component which is called as profit in lieu of salary. What is profit in lieu of salary? I had explained you earlier. So these are the list of profit in lieu of salary. You can refer to our earlier slides, recorded videos are also available. You can understand what is the meaning of profit in lieu of salary. This is also an important component of salary, right? Any compensation due or received from employer or former employer in connection with the termination or modification of terms and conditions. Okay, any payment due or received by assessee from an employer, former employer, except these things. Okay, then transfer amount of recognized unrecognized provident fund to other fund, or like this. So these are the items which constitute profit in lieu of salary. This also forms a part of salary. Okay, so in the recorded video, you can pause it and you can watch it. What are the components? So salary includes all these things. Okay, wages, etc. So many items are included. So many allowances, so many properties and profit in lieu of salary, all the components of the salary. And from this salary amount, there are 3 deductions under this chapter. You can say chapter specific deductions. Okay, can you read these deductions? Which kind of deductions we are talking about?
Standard deduction, professional tax, and entertainment allowances.
Entertainment allowances. These are the 3 deductions. One is standard deduction, second is professional tax, third is entertainment allowance. So standard deduction means a kind of fixed deduction. I'll be telling you maybe in the next class. Today I don't want to continue with that. Some other things are also there we need to learn in the next class. So a fixed amount of deduction, that is standard. Okay, standard deduction is allowed. And second is professional tax. What is professional tax? Professional tax means it is in fact a state government tax. Our Constitution of India has given power to the state governments to levy tax on employment. That is called professional tax. But there is a maximum ceiling. Maximum amount can be up to 2,500. So if different state governments have their different slab for professional tax. Okay, how can you find it? If you visit to state government's commercial tax website, you can find out what is the rate of professional tax. Okay, similarly, if you are talking about the state of Odisha, you can visit to the commercial tax department site of Odisha government. You can find out what is the professional tax payable by employees, right? Okay, so that's state government tax, and that tax is also one deduction because employees spending that money for employment. So standard deduction is one deduction, and this is one more deduction. And third deduction is about entertainment allowance. Entertainment allowance is taxable; it is to be included. But out of that, how much is deducted? For private employees, it is fully, no deduction is allowed. It's fully taxable. For government employees, there are some deductions. So we'll be learning that. Okay. After these 3 deductions, we'll be able to find out what is the income under the head salaries. Okay. So the deductions we are going to learn in our next class. So again, I repeat, overall, if you see the structure, when we talk about the salary, we include basic salary, we include allowances, we include perquisites, we include property in lieu of salary. All these things are included. Then we deduct 3 deductions. Who can tell me what are the 3 deductions quickly?
Standard deduction, professional tax, and entertainment allowance.
Entertainment allowance. Okay, then we will be getting salary income. Okay, so like this, under each heads, there will be some specific deductions. Okay, there are some deductions on income from house property. We'll be learning that thing after this. Once salary chapter gets over, so we'll be learning that thing. Okay, so like this. So from all heads, we'll arrive at the income under different heads. Then that will be aggregated. Then set this clubbing provision and set up and carry forward of losses provisions will be applied. Then chapter 16 deductions will be applied. Then we'll be getting what is the total income on which tax will be paid. Okay, so friends, this deduction and some overall miscellaneous issues are there. Let us say TDS part, etc. We are planning to cover in our next class. We are going to close our show right now today. In case you got any query, please let me know quickly. Let me know right now. In case you need.
What is the meaning of clubbing provisions?
Clubbing provision means, clubbing means what? Adding. That means some other person's income also is to be clubbed. There is a separate chapter for you. At appropriate time, you will be learning. But right now, you understand.
Excuse me, sir.
Yeah, please tell me. Okay, let me first finish this thing. Clubbing provision means, let us say, in certain situation, minor child's income needs to be clubbed. What can be situation? Let us say, minor child has earned some income, not exercise, not by use of his skill, not used by using his own labor, etc. But he has got some income. That income in certain situation may be clubbed with either of the parents' income, which income is higher. That provisions will be learning at appropriate time. Similarly, if some asset, some income is transferred to spouse without transfer of asset, so that income, the spouse income, can also be clubbed with, needs to be clubbed with the income of the other spouse, right? So these are some provisions, and under these provisions, some other person's income are getting merged with your income or assessed income. That is called as clubbing provision. Are you getting? Did you understand?
Yes, sir.
Yeah. What is the other query? Who can tell me quickly? Any other query you have?
Sir, sir, when we will get the notes of tax law?
Tax law videos are uploaded on regular basis. You can visit to my YouTube channel and you can find it out.
Oh.
Sir, for the calculation of entertainment allowance, that is 20% of salary.
Yeah.
So is that just the basic or basic plus DA?
See, entertainment allowance, let us keep it for next class. Okay. At that time,
Okay.
I will be explaining you. Okay.
Okay.
Now it will be, you are right that 20% or 1/5 of the salary is relevant, but please, we will keep it for next class because we have not started that thing.
Okay. Thank you,
Okay.
sir. Sir, you'll be handling the portion of assessment revisions and appeal, that chapter you'll be handling? Assessment revision. Appeal.
We'll see. We have not planned anything like that. Maybe once this chapter gets over, we'll think about that.
Okay. Thank you, sir.
Okay. So, okay. Thank you very much, friends. See you in the next class. Thanks a lot.
Thank you, sir. Thanks for explaining.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you. Thank